Well, welcome to the recorded session of today's program, and we're excited to bring this information to you. And let's get going. So I just want to give you a quick overview of the market size and how we've approached this, and each of the tools fill in here, but just want to understand how you need to approach the problem. So there's about 6 million students or families that apply or are searching or getting ready for college each year. About 2 million students will apply to college each year. So that's the planning side on the front end. Then you have about 21 million that are in college making ongoing decisions. This would include undergraduate, graduate, and also your technical school. So there's 21 million people that are in that space. Then you have about 23 million that are in repayment. They're no longer in school. They're making payments or supposed to be making payments. And so that's where some of the confusion comes into play. So we look at these numbers here, and we hear about the 44, the 45 million, depending on what survey you look at. That is the total number that have student debt. So not everyone is in repayment. So that's an important part you need to recognize. Now, within the 23 million, only about half of those people have debt that's over the $10,000 mark. So that is another issue that we have to look at. It's still a lot of people, but when you look at what the problem is, or the problem that's coming and the opportunity that stands in front of you, is we have a lot more people moving into the 23 million over the next 2, 3, 5, 10 years. And this is why, student loan repayment is going to be a critical piece of your business or you as a financial advisor to have this in your skill set. So that I just wanted to give you why we have developed this holistic approach, because I think part of the problem that we need to solve is the prevention. And that's what we've created here is a tool that evolves with the student so they can see the transparency, to see the debt that prevents the student debt crisis that they may face once they're in their 20s or 25s or when they go back to grad school, by seeing the end point. That doesn't exist today, as far as we know. And what we're trying to be is a trusted second opinion. So the evolution starts in high school, as we just saw the market size and what we call our analyzer, and then you move across to payment. And this is not just the people who are in school, but also the people who are considering going back to school. As we've approached different companies on financial wellness programs, they are also looking for more of a holistic approach. The hot topic or the hot benefit right now is a student loan repayment. And we're seeing many of the HR companies and benefit companies taking a step back and saying, that's only hitting a portion or a small portion of our population. We need to be more holistic. And I think that's what we bring to the table here, and that you can bring to the tables to both your clients and to local companies as being an expert in not just the repayment side, but also in the prevention side. And this kind of goes into the whole method or approach as we make decisions. And as I said, there's no transparency to the outcome. So, when we buy a car or buy a house, we get approved by the debt number that we're applying for, but also the monthly payment, and can our income support that monthly payment? With student loans, the decisions we're making, there is no transparency to the outcome. We try to provide that on a projected basis, but your debt structure, your income, your tax filing decisions, your marital status, and your family size all have an impact on what your loan repayment options are going to be and what your loan forgiveness options are going to be. So all these decisions that we come together, as a comparison we just talked about, the house or mortgage, those issues are fairly simple in comparison to what we're trying to face here and solve. And this is where, again, having an outcome or a plan to see what you can do before you make the mistake is difficult to find. Here is just a breakdown and kind of the history that we're trying to also present to you today, and seeing where the debt is. And what's kind of alarming in this, and I apologize, this was a screenshot of another study, but in this case you can see the people over 30, from 13 to 17, we haven't seen a lot of increase in debt. I mean, it's not substantial. But if we go to the other end of this, the people over 60 and the people over 50, look at that increase that we're starting to see here. And the difference there is more and more parents, because of education going up, are doing two things. Either they're going back to get retrained for themselves, or they're taking the Parent Plus loans and adding that debt onto themselves. So we're seeing an increase in these areas that are becoming more and more difficult, and which will then put a more complicated situation into the retirement ages when they carry that debt into retirement. So This is another reason why you'd want to add in student loan repayment and understand where you can help the retirees who may have that. And you'd be surprised who may actually have that student debt. It's more people than you think. Here's another example of what the storm ahead. I call this the storm ahead's in front of us. We have a traditional mindset of looking at student loan repayment in the car payment or mortgage, a fixed amount that has an amortization table that's fixed. In 2016, we saw a transition, and there's multiple factors of why this is happening. Some of it's due to the loan servicers and what they present to the students as in their repayment. It's partly also due to the high increases in cost and also because of how the debt is structured. But in 2016, we saw that the income-driven repayment methods now are more used than the standard repayment methods. And the standard repayment methods are your fixed amounts and amortization table that the debt is taken away each month. A portion of the payment goes against the principal. With income-driven repayment, now we have more people enrolled in income-driven repayment methods, which is based off the income. So in many of those cases, you'll have negative amortization. So as I said, it's a storm ahead. One, we have more people being exposed to that methodology and not understanding it. But two, we're also going to be seeing rises of student loans or the balances and people still having the traditional mindset that their payments are going against principal, but they really don't know what's really happening. So again, this is the other opportunity that you have in front of us, and this is why financial wellness companies and employers are looking at trying to find solutions, because of financial stress and the financial wellness of their employees is slowly being taken away. This just gives you an overview of the people qualifying for public loan forgiveness. There's been a lot of issues and complaints here. In this year's budget, there was a $250 million number that was put out there because of the misinformation the loan servicer had and have given to people over the years. So here's where there's trying to make up for some of those problems, but you can see a few things in this chart. This comes from the Fed Loan Servicing, who are the ones that monitor the public loan forgiveness. And you'll see a lot of people in the front end that try to qualify for public loan forgiveness, but what happens is careers get in their way or they're not compliant. So you see a big drop off in that 25 to 48 months. This could be the school teacher that taught for a few years and decided that's not their career. They may have qualified for loan forgiveness at the beginning and didn't. Or maybe the nurse, or maybe a big issue here is the taxes and things. They didn't know how to file their taxes the right way to maximize this opportunity. And as you're seeing, the numbers are diminishing, and we're going to see in a few more minutes at the end of this presentation, this is one of the topics that's being talked about because of the lack of participation or the people qualifying for public loan forgiveness that they're considering taking it away. As I mentioned before, we have a traditional mindset of student loan repayment in the traditional loan repayment method. So we have a look at looking at the amount, what our interest rate is, how much time are we going to take, what's the monthly payment. Just like a mortgage or car payment, we're always trying to minimize those amounts or pay the least amount over time. Again, that's mostly going to be interest rate and time related, which in many cases is the right option. But as we just saw a few minutes ago, the trend is actually moving to what's called income-driven repayment methods, and now we have to change our mindset. Still, again, in many cases, the amount and interest rates will be important. But if your employees or your clients are now enrolled in income-based repayment, your mindset has to change. You have to now look at what is their adjusted gross income. How do we manage that? And is that managed at a joint level if they're a married couple, or is it married and separate? All those factors will be important in managing their loan repayment to maximize either their loan forgiveness or their future goals. What's also going to be important is the marital status of them. Should they get married? Do they file their taxes married and joint, married and separate? What's the financial consequence? We're going to see in a slide coming up all the information or advice is very siloed, and here's where you have the opportunity as an advisor to bring this together. How your debt is structured. Do I have private loans versus federal loans? This again is part of the flexibility and the decision-making process that is often overlooked or not understood by the consumer due to the complexities and lack of information. And then what type of loan forgiveness is out there? What are the rules around there? Who's the employer? How does that all work? Is it public loan forgiveness? Is it taxable at the end? Here are different issues that you as an advisor can provide to clients that are a growing concern for many, many people. As I just said, a lot of the current advice is siloed. And what I mean by it's siloed is that the loan servicer's objective is to help the borrower stay current. Student loan repayment has one of the highest default rates of any type of repayment. So their goal really is to avoid default. As a part of that, the lowest payment typically is an IDR method, as we just saw a few minutes ago, but there's other consequences that are not explained, such as negative amortization or how we have to file our taxes, and they can't provide that information to you. Then we move on to the tax advisors. The tax advisors, their goal is to really lower your taxes. They don't see the financial consequences of you filing your taxes married and separate. Their job is to keep your taxes as low as possible and don't see that consequence. Then you have the private lenders, and their job is really to make you a customer. And how do they do that? Well, they make it attractive, or make you think it's attractive, and it still may be, to refinance your loans to their bank so they can make more money. That it may not always be the best decision for your client or for the advice that you give based on their situation and the combination of your couples. As you see here, each of them have different goals that you can be the aggregator of all this and help your client become more informed and provide a more comprehensive and objective view. So the way I talk about this is the untold story. And what I mean by that is we have to factor in other things, such as our marital status, our tax filing, how we do that, married, separate, married, and joint. What is the tax consequence of these decisions? How is the debt structure? Should I do a private consolidation? What impact will that have on my other spouse? And how's the cash flow? What are the best methods for me to maximize my repayment methods to lower my out-of-pocket cost over time and making the best decisions? What is not explained to people is that for a married couple who both have federal loans, they actually have 126 different options to consider in making their loan repayments and reaching their financial goals. This is never explained to them. And as we saw before, as an example, the loan servicers, they cannot cross over the bounds of giving professional advice or personal financial advice, such as how you should file your taxes. This is where you as the advisor can give that more holistic view of a couple who is now trying to minimize their debt, repay back their student loans, and reach other financial goals such as starting a family, buy the house, save for retirement. So here are the decisions as broken up into different pieces by category. And you'll see the combination of when we see the screens here in a few more minutes of how this all comes together. So the importance of filing your taxes, if you're single or head of household, and size of family, you may stay the way that is. So you may be head of household, maybe you're divorced, you may just be a single. This will be the simplest way to get repayment. There's many of the tools that are out there that just handle a single person, and we believe that's part of the problem. But also, some of those tools will lead you to do refinancing, and what you need to see is that future impact of if we now do a private consolidation when we just get out of school, because we look at interest rates and realize we have high debt, and now we get married, that will now limit what ways we can repay our loans and how we have to file our taxes. So again, understanding that information, at least presenting it to the client so they can see the financial consequences of those decisions, is important. Then you have the married couple. Now, what's interesting here with the married couple, they have the objective of filing married and joint or married and separate. What we're seeing more and more uniqueness here is that maybe one has gone back to school, their loans have been in deferment, and so they've maybe filed their taxes for a few years as married and joint. Now one of them graduates, and once they've graduated, now they have to start repayment, and that may need to change how they file their taxes. So in this case, they're going to now have to file married and separate to maximize their either loan forgiveness or minimize their student debt repayment, because this is going to improve managing that adjusted gross income. And then we have the last group, which is a recently married / engaged. And these are the people who are currently head of household, single, and are getting married, and now are going to have a difference or not seeing what's their financial consequence to repayment if they file their taxes married and joint or married and separate. So you have to take two single people as an example and run their taxes both ways as married and joint and married and separate. And by just getting married, they lose, as an example, the student loan interest deduction. As two single people that both have federal student loans could have a $5,000 deduction, and now the best solution will be for them to be married and separate because of how the debt is done, may lose a $5,000 deduction, which is now going to increase their taxes substantially. So these are the type of things that you as the advisor can at least explain to them and see and show them the financial consequences. Also, as I just mentioned, how their debt is structured becomes more and more important. And this has to do with how the calculations work. If they both have federal loans, the calculation works this way, that it's their income or joint income is divided by the loan balance that each of them have. Where if they file married and separate, depending on how their debt is structured, assuming they're federal loans, that percent can be very, very different and sway how you're going to do that. And maybe one qualifies for loan forgiveness, one doesn't. This is where you as the advisor can add the additional insights that the individual can use. Other loans such as private loans or Parent Plus loans that a student may be responsible in paying back, yes, the Parent Plus loan is a federal loan, but it's actually the parent's responsibility. And this is, again, where you can come in. That Parent Plus loan, even though it's a federal loan, will not qualify, again, if it's the students, will not qualify for the various loan repayment and loan forgiveness situations in most cases. Then you have the refinancing decision. What's the financial consequence if one should do a private consolidation and they get married, and now the calculation is going to hurt them, because if they file their taxes married and joint, 100% of their income is going to go against only one person that has the federal loans. So this may force them to file their taxes married and separate to improve their loan repayment amount per month. Also, a big mistake we see with married couples is they want to show their independence. So maybe at the time of or prior to marriage, they both have federal loans, or maybe they have a private loan, and now the other spouse has good credit, maybe they both have good credit, but they decide to do a refinancing and the other spouse co-signs. Once that co-signment happens and it's both people that sign it, that will affect their ability to now qualify for different types of mortgages, because their debt to income ratios will now be collective, where if they kept the original, which is typically a parent, the original co-signer, that other spouse has a little more freedom and maybe have better debt to income ratios to qualify for the financing they're looking for. So this is something else that many young married couples overlook or don't understand the financial consequence of co-signing their spouse's loans, and down the road, God forbid, if they should get divorced, that will have another impact on them that they probably didn't want to do. And then loan forgiveness. Here again, your debt structure, only the direct federal loans qualify for loan forgiveness. If we do a private consolidation, you cannot move back to the federal program. So again, if someone's thinking about going to school or going to maybe have a career change, here's where if you leave the federal programs, it becomes very, very difficult. I wanted to give a quick overview of the forgiveness programs, just because it becomes part of the decision making. If a client comes in and looks at, when we're looking at forgiveness, and again, there's a lot of conflicts and misinformation out there. We have a tendency to look at highlights and they think they're going to qualify, and they really won't. To qualify for loan forgiveness, you need to have federal loans. They need to be federal, in most cases, federal direct loans. So if you have public service loan forgiveness, if you now work for the government or a nonprofit, you need to make 120 on-time payments. You need to be under one of the IDR methods. They need to be direct student loans. They need to be a full-time employee over that 120 on-time payments. Now, they do not need to be consecutive. So maybe I work for 4 or 5 years, decide to either work somewhere else in a private institution, or maybe decide to have a family and work part-time, and I'm still making payments, but my payments will now, those payments will not qualify for public loan forgiveness because I'm not a full-time employee. The public loan forgiveness amount is also tax-free, and we would recommend this will need to be recertified each year if you use one of the IDR methods. In addition, if you change jobs, you need to have your public service loan forgiveness form resubmitted. Your certification of employment each year or anytime you change jobs is what we recommend. Now, there's also the other federal loan forgiveness programs that go out to 20 and 25 years. Those amounts are taxable. Now, we're seeing some of the higher careers that maybe would consider this. You need to be very careful here, because as an example, say someone has $200,000 or $250,000 of student debt, and maybe they're making $100,000 to $150,000. Now, they may have negative amortization, so after the 20 or 25 years, that debt grows to, say, $300,000. Well, now, if they were making $125,000 in that year, and the debt is forgiven 20 years from now, that $300,000 will come in as income. And so in the year they will file their taxes, their actual income would be $425,000. Whatever the marginal tax bracket will be that year, that's how much they'll have to pay back in taxes. So it's not 100% tax-free. In the loan forgiveness, it's multiple years, it is taxable. So that is something that needs to be planned for if that is going to be the course of action of a client. So I wanted to run through a case study here to give you an example, a real life example of how things can work together and how we've approached this for the married couple. We believe we're the only tool that does or has the system that handles the married couple. So in this case, we have a couple. They both have federal loans at this point in time. One has $65,000, the other one has $97,000. One makes $50,000, one makes $60,000. They're themselves as individuals, so they're individual exemptions. One qualifies for public loan forgiveness, or both of them have a match from their employer. And then if they file their taxes married and joint, their tax burden would be $84.39. Now, if they file their taxes married and separate, they're going to see an increase of $730 on an annual basis. So here's again, the tax advisor would say, well, why would you ever do that? And the problem where is on the next screen is the tax advisor will not see this impact. The difference of how they file their taxes and how the debt is structured. So we see both of them are still making retirement contributions individually, $5,000 into their plan. Now, if we look at pay-as-you-earn as an example, these are monthly numbers. Their monthly payment, if they file married and joint and they both have federal loans, will be at $322. Now, that sounds an attractive number. Now, if they now move and one of them should do this is spouse one, does a refinancing. Because of how the calculation works, it's 100% of their income and only one has federal loans, their amount's going to go up to $586 with just that change because they did a refinancing. One spouse either didn't know or they thought it was a better idea. Their decision to do that is going to increase their monthly payment on the spouse two's number to $586. Now, if we then continue and now relook at how we're going to file our taxes, now we're going to increase our annual number by $730, which is $61 a month, but our loan repayment amount will go to $244. And now we can see how that's going to work. And they're going to qualify for public loan forgiveness. And now we put also all the retirement money in one place because that's managing through the AGI number. This can now achieve them maximizing their $10,000 in retirement and also lowering their monthly payment from $586 or $322 to $244, which is a substantial amount of money and will then be offset by the $61 that's there. So this is the type of financial advice that you can provide to clients to improve their financial life and make you innovative in the way you think about loan repayment and attract new clients. So just to review what we just said there, as you can see, the pay-as-you-earn is what we just said, is they had a monthly payment up to $586 if they didn't see it, and it could go to as low as $244. So that's a $342 savings that is cash in their pocket, which can go to their other financial goals. So maybe they're trying to save for a house, or maybe put more for retirement, or maybe start a family. Here are things where you can provide actual cash in their hands by just a few tweaks of them understanding how their numbers need to work together. As I said, the loan servicers cannot provide this information to them because it crosses over giving them personal financial advice. As you saw there's 126 different options or combinations that the couple needs to consider if they both have federal loans. And this loan servicer can only really give you 8 to 16 options on your repayment because they can't look at that holistic view. As you saw here, the tax filing and debt structure are overlooked all the time in this analysis. You cannot see this until you use what we believe is the best tool out there. By having this information, you can help them improve their financial future, reduce their stress, improve their employment satisfaction if this is a company benefit, and just improve their financial life and goal setting that they may have in their future. So let me just go through the system here and give you an idea of how we approach this. Again, looking at the things you need to consider in each step of the analysis. If you're doing this by hand, you can use the federal loan program. It doesn't do the tax analysis or the tax differentials. It doesn't handle private loans. And again, there's a holistic approach that we take throughout all of our systems, but this will be the approach and things you need to think about as you step through this with your clients for married couples. So first is understanding, what state do they live in, what's their current marital status, how do they currently file their taxes. So again, transitions from married and joint to married and separate, the engaged couple, all these are things there. Do they qualify for public loan forgiveness? And what type of loans do they have? And then what are they paying per month? Again, trying to understand the entire picture is critical in making the right decision. This is our first step, and then in this sets up all the driven other screens that we have to decide that. The next part of the system is getting an inventory of their loans. So we recommend you have their FSA ID, and then you go out to the National Student Loan Database. Our system, you're able to import this information directly into the system, and then creates an inventory of their entire student loan debt. So you can now see what this person's student loan debt is on the federal side. If you need more detail, they possibly have their other loans, such as their private loans. You can run a credit report that will help you find the rest of it. That actually will have all the debt, but we find the best source is the National Student Loan Database system for their federal loans. But it's important you see both their federal and private in one place, and I think we're also the only tool that helps you do that by person. And this needs to be by person. And one thing here, as I said earlier, your Parent Plus loans, we're seeing more and more younger individuals where the parents have financed this, and the student is responsible to pay back that federal loan that their parents have. Now, granted, legally it's the parents, but they have the responsibility to their parents to pay it back. That will not come down as part of the National Student Loan Database system because it's under the parent's FSA ID. So that's something else you'll need to ask of them. Then once you have that information, we're then going to take and give you the options of how you file your taxes. So the first part is how they currently file their taxes at married and joint. In this case, they are filing married and joint. There's two dependents. Their joint income is $110,000. As a married couple filing joint, they will qualify for the $2,500 student loan interest deduction. So they maxed out there, and now they made some other adjustments. They have retirement savings. There's the $10,000. They put that in an IRA. So there's their adjusted gross income. Now, if we move across, if you notice, they lose the deduction for the student loan interest deduction, yet they still have the retirement deduction getting to their AGI numbers. And now we can see what the tax differential is, and that's where we see that 730 that we saw earlier in the demo. So again, this is an important part of understanding what we currently are doing to what you could be. Now, in our recommendations, this is a very simple estimation of what your taxes could be. We highly recommend that the client have their taxes done professionally, because now, especially if more sophistication comes into that, such as if they have children, who claims the children, claims the deduction for different things. These are all parts of the tax analysis that we believe someone else needs to do and not just us. Once you have your tax information, we have the student loans, then we can start seeing the combinations of how the numbers and your different loan repayment options come together. So on the top here, we can see married and joint with both federal loans, married and joint with only one having federal loans. So person one doesn't have any federal loans at this point in time. Maybe they did a refinancing, so they have zero repayments. Then they do married and joint with person two. And here's where you can see the difference. There's the 322. The 586. Now, if we now move to married and separate and both have federal loans, so now it's a one-to-one relationship on your income and your debt. Now that number, the 286, is not the 244, but in the screenshot that we have here, the reason why it's not the 244 is because the other $5,000 is still sitting in person's one adjusted gross income. And that's why we had made that other adjustment. But that's the professional advice you can see and add and play around with some of the numbers to maximize the returns here. But as you can see here, then we move down, and now they're going to pick here. When you're in the live system, it becomes crosshairs in as far as what you have. So once we see person one or the married and joint and file both taxes, you highlight which way they're going to be filing their taxes and how the debt is structured. And then person one and person two are under each other. And when you click those numbers or the different methods, that is what gets saved and it moves down. So once you pick the different filing method, and then that will flow down to person two, you cannot have a combination of the tax structure and the debt. So how the 126 number comes together is that we have 7 combinations of how we file our taxes and how the debt can be structured as a couple. Then we have 9 different loan repayments, and then we have 2 people that have those choices. So that's how the number comes together. So once we make the decisions between the 2 people that have their student loans, in this case the number was 880, we then can build a customized budget. And now once we can see that, we can see if they're going to be cash flow positive from a lifestyle standpoint. So again, maybe being more aggressive and trying to pay that debt down may not work in their budget as a total lifestyle. And this now allows you both to see what their goals are from a student loan repayment standpoint, but how does it affect the true living expenses and other goals that they may have. Again, you can add this in, you can customize those numbers by expanding that. We click that and have a customized budget, improves their financial literacy, and they can see the different impacts on their repayments. If they want to repay sooner, there is no prepayment for the federal programs, and for many of the private lenders, there's no prepayment penalty. But again, here's where you can see a combination of both their options on the top side, and then how's that roll through to their actual living expenses. When you see the approach here, what's very different when we first build the system, and the approach we're looking at is building the detail. You could see that we would have needed a separate spreadsheet to do that, because you would have had to pick through the 126 different options. So what we also did is show you the detail here on the next step. What's often overlooked in the income-driven repayment methods is negative amortization. So what we've done here is identify that their interest charge on their current outstanding debt is $445 as when they brought it in. Now, when we look at the repayment methods they have, in this case, by chance, and again, they file their taxes married and separate, they don't qualify, or their interest amount is above that $445, so we don't have negative amortization. Now, again, if they're qualifying for public loan forgiveness, that may still work. That's why we see the public service loan forgiveness being selected. Now, what's also interesting here is we give you what the adjusted gross income needs to be managed to maintain that payment style. So if we have here the repay method was selected, you as the advisor or them as an individual needs to manage this person's AGI number to 146,678 to stay in that number, to stay at that 586 number. Granted, each year it changes, the calculation changes, there's a few adjustments. If they should exceed that 146 number, what will happen is they will then move up to the 10-year standard number, which is the 1,017. So again, the combination here that's happening, you need to understand, and this way we give you the tools. Some of the other tools out there, or way you approach this, you look at their annual salary, and that's not going to be good enough, because say that raise or that increase happened in July or August, that's only a partial year. They still may qualify. You're not looking at a number. It's based off your tax submissions or your most recent taxes on file. So again, here's where you as the advisor can come in and say, okay, well, we have a much higher income on an annual basis, but for this year, we can project out, if we do this, this, and this, we can manage our AGI numbers to a lower number that would maintain the lower payment for another year. And especially if they're going to qualify for public loan forgiveness, it's more money in their pocket. When you have public loan forgiveness, having negative amortization is not an issue. What you're trying to do is minimize their adjusted gross income, maximize their retirement savings to maximize the program both on a forgiveness basis and on a cash flow basis. So as part of our approach, and these are the things that you need to be aware of, there's a lot of searching going on by the clients, trying to find the customized solution, and more importantly, probably the confidentiality. Where we're seeing more and more websites out there that are free and don't cost anything, but as you can see here, they have to lay out their entire financial life in many cases. This is where we don't sell any information. Once it goes into the system, this information goes nowhere. Here's where you can be recognized as a trusted second opinion. You can analyze all 126 different options in one place, again, giving them a more holistic view. They can see the financial consequences. So what happens if I do a refinancing of one person's debt? If we decide to see what happens, now do we have to file our taxes married and separate? Or that engaged couple where maybe one of the couples has already done a private consolidation, and they may have, that's where they're going to be limited in their choices. As I said earlier, once you move to the private side, you do a private consolidation, you cannot move back to the federal side with existing loans. If now you go back to grad school, you could then incur that future debt with federal loans. But once you leave the federal program, those debts that moved across can no longer move back. That is also something you need to consider. I think by having this information, you can help them reach their other personal and financial goals, which would include, the home purchase or having a family or paying for education or whatever it may be. I think we provide, or what you can provide here with our help, is the clarity of the unknown. I think there's a lot of frustration on finding the advice. As we said, people go to different people, and there is that holistic view, but brings the loan repayment options, the debt structure, and the tax scenarios all in one place, as you can see how they're all intertwined. That kind of concludes the overall here. I just wanted to touch on a few things that you need to be prepared for in the upcoming year that's going to happen. So there's this PROSPER Act, it's the renewal of the Higher Education Act. What we're trying to see, or what that plan is trying to do, is improve the transparency and simplification of the process. There's about 36 states at this point in time that have started to benchmark all the colleges on their utilization of their funds and their graduation rates and retention rates because of how tuition is increasing. And there could be a consequence down the road for them. What we're seeing here is the debt structure growing, and they believe because the current PLUS loan programs, both the parent and graduate, have unlimited amounts. So you could basically borrow as much as you need. What is being discussed is there could be loan limits for either one of those or both. The numbers they're talking about is $15,000 to about $30,000 depending on the loans. Some of the graduate loans could be higher. The parents right at this point look like they're going to be a little bit lower. That's going to add additional complexity. It's going to limit what the schools maybe can increase parents from borrowing, because they won't be able to increase tuition as much. And this is one of the first steps on stopping this out of control debt crisis. One of the other things they're talking about is simplifying the process with one loan, one repayment method on the IDR method. So they'll still have a few different fixed methods, but currently, as you saw, we have 4 or 5 different income-driven repayment methods. Again, there'll be a transition time frame, which could make it more complex for a little while. But again, what the goal is to move to one loan, one repayment. And as you saw in the very early slides, we went to public service loan forgiveness. They may eliminate that. And you can see by the numbers, it's really not as effective as they were hoping. And that is a political nightmare for some people, but you can see the numbers. Does it really justify the expense to maintain all that extra work? So this is starting to conclude the presentation here. We believe by looking at this and having the education background, here you as the advisor really can differentiate yourself from other advisors. If you're now looking to attract those Henry clients, the high earners, not rich yet clients, you need to add student loan repayment into your portfolio of knowledge. We think it's absolutely critical, because more and more careers requiring postgraduate studies, things that you would not expect. As an example, my daughter is a speech pathologist. You need to have your master's to have that job. An accountant needs 150 credits now to sit for the CPA exam. So we're seeing more and more need for more education, which is in most cases going to be borrowed because it's just that expensive. So this again is an important part of why you need to add it into your portfolio of services. We believe it's a new place for revenue sources as we move to more of a fee model, and especially as the millennials start moving in on how they use the internet and how they use technology. It is the top benefit being added. We're getting a lot of traction in the student loan repayment benefit. It's part of financial wellness. It reduces employee stress. Again, what's happened is we believe our tool is a great fit, but when we have implemented this into companies, some people have additional questions, and here's where you could do a lunch and learn. There's things where this can be a great prospecting tool for you in the right situation. What's another important part, I think, is the wealth transfer that's in front of you. By having student loan repayment, you can enhance your relationship with the next generation or with your existing client. And we've seen this more and more happen, where clients maybe have paid for that undergraduate degree, and now their child graduates or goes to graduate school and has high debt. This is where you can come in and complement your existing services with them and improve that relationship. The other situation where we see it happens quite often is the client that their child, maybe they've paid for their education, they're financially strong, and their child marries someone with debt. That's going to be an anchor for that their child, dragging them along, not being able to, reach those other financial goals, such as buying a house and other things like that. So again, here are a few different reasons why we believe having the knowledge in this space and having tools to deliver this is becoming more and more important for a holistic approach to financial planning in as a profession. So just as a quick view here, we have the CFSL training program. It's FINRA listed. It increases your market exposure. As we're seeing benefits in the financial wellness programs. The program is 22 CFPCEs. As an example, this is one credit that you would have for it. But as part of this, keeping, as you can see, there's many moving pieces. You get financial alerts. We keep you up to date in this. And there's quarterly webinars that you can ask questions. Again, and we'll hit topics that are pertinent at that time of year or of change that possibly happened. So that concludes today's presentation. We're going to move back to the hybrid part of the webinar. Hopefully you've typed in some questions, and we'll be consolidating those and ready to answer those in the next segment. We'll see you on the other side. Thanks.